So your business is growing, right? And eventually, that means you're going to need new equipment. But the huge question is always, how do you pay for it without totally draining your cash reserves? Well, that's exactly what we're going to break down right now. All right, so you've got your eye on that perfect machine, that game-changing piece of tech, the vehicle that's going to completely transform how you do business. Now comes the million-dollar question. What's the smartest financial move? Should you lease it, buy it with a loan, or is there another way entirely?
Okay, here's our game plan. Think of this as our roadmap. We're going to start at what I call the equipment crossroads. Then we'll explore the leasing path, followed by the loan and ownership path. After that, we'll get into the nitty-gritty and decode all the details, and we'll wrap up by building a framework so you can make the absolute best decision.
First up, let's head down the leasing path. For a lot of businesses, this is the go-to option for getting equipment fast while keeping things flexible and, most importantly, protecting that precious cash flow.
Yeah, you can really think of leasing like a super strategic rent-to-own deal. You get the equipment you need today, but your cash stays right there in the bank, where it belongs, working for you. Plus, with predictable monthly payments and usually no down payment, it makes budgeting a whole lot easier and keeps your capital ready for anything.
And wow, this slide really puts it in black and white, doesn't it? With a lease, it's simple. The equipment is the collateral. But look over at the traditional bank financing side. They might ask for collateral worth 2, maybe even 3 times the loan amount. That can tie up your other assets and really limit your ability to borrow down the road. Now, don't get me wrong, if you have a fantastic long-term relationship with your bank and rock-solid credit, you might get the lowest rate there, but it often comes with all these strings attached.
Okay, so let's say leasing is sounding pretty good. You're not done yet, because now you've got another choice to make. It's definitely not a one-size-fits-all situation, and the type of lease you pick really hinges on what you plan to do with the equipment in the long run.
So here's how it boils down. An FMV, or fair market value lease, is basically like renting. You get the absolute lowest monthly payment, which is perfect for tech that's going to be yesterday's news in a couple of years. A dollar-out lease, on the other hand, is built for ownership. The payments are a bit higher, sure, but at the end of the term, that piece of equipment is all yours for, you guessed it, $1 single.
All right, let's switch gears and talk about our second major path, the loan and ownership route. This one is all about building equity, the actual value of the assets you own, right from day one.
So like we just touched on, a standard bank loan means you own that equipment right away, but man, it can be a tough road. That high collateral, the rigid payment plans, and all that paperwork can be a serious drag for a growing business.
But hold on. Don't write off ownership just because of the traditional bank loan headaches. Because there's this incredible, government-backed alternative that was literally designed to fix these exact problems, the SBA 504 loan program.
And this is where the magic really happens with the 504 loan. Just look at that breakdown. The bank covers 50%, an SBA partner covers 40%, and you only have to come up with 10% equity. That's huge. It means you keep 90% of your capital free to use for running the business, for inventory, for growth. I mean, the benefits here are just huge. That low 10% down payment is obviously the start of the show, but look at what else you're getting, a long-term fixed interest rate. That means no surprises. You get stability and you're protected from rising rates or those dreaded balloon payments that can totally sink a business.
Okay, so no matter which path you're leaning towards, lease or loan, you're going to run into some specific lingo and numbers. Let's decode the important stuff so you can walk into any conversation feeling confident.
Okay, the big question on everyone's mind. What's my rate going to be? Your APR, or annual percentage rate. Well, here's the bottom line. Your credit score is the #1 thing that drives your rate. As you can see, a score over 700 can land you a nice single-digit rate, but if it dips below 600, that rate can climb up towards 20% or even higher. Man, it just goes to show how much it pays to keep that credit score healthy.
But wait, it's not just your credit score. Lenders are looking at the whole picture. How long is the loan term? What kind of equipment is it? And what's it worth? How much cash are you putting down? And of course, who are you borrowing from? A traditional bank is almost always going to have lower rates than a fast and easy online lender.
Okay, listen up, because this is a really, really important tip. Before you let any lender check your credit, you need to ask them one simple question. Is this a soft pull or a hard pull? A soft pull lets you check rates and see what you might qualify for with zero impact on your credit score. It lets you shop around completely risk-free.
And that brings us to another pair of terms that sound similar but are totally different: pre-qualification and pre-approval. Think of it this way.
Pre-qualification is like window shopping. It gives you a ballpark idea of what you can afford. But pre-approval, that's a firm offer. That means the lender has done their homework and they are ready to go with set rates and terms, all locked in.
All right, we've covered a ton of ground. You've got the map, you know the language. Now let's talk about how to actually pick your destination and make the right call for your business.
You know, at the end of the day, this isn't just about getting a check. It's so much more than that. This is a strategic move that can either launch your business forward or hold it back. It's really about fueling your vision for the future. So here's a simple 3-step framework you can use right away. First, step back and look at the big picture. Your goals, your budget. Second, do your homework and figure out the total cost of that equipment. Not just the price tag, but shipping, training, everything. And third, and this is non-negotiable, sit down with your accountant and crunch the numbers on the total cost of each option, including the tax implications.
And that really brings us to the most important thing to remember. The right choice for this purchase might not be the right choice for the next one. A good rule of thumb is lease if you prioritize flexibility and cash flow, buy with something like an SBA loan if you're building long-term assets and crave stability. As this quote says, your business is always changing, and your financing strategy needs to change right along with it.
So there you have it. You are now totally equipped with the knowledge you need to make a smart, strategic decision. You've got the map. The only question left is, which path will you choose to fuel your company's growth?